My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, teach you, and put big days like this in context. So call me at 1-800-743-CNBC or tweet me, of course, at Jim Cramer. Right now, the stock market and the bond market are like two heavyweight champions duking it out. And today's stocks had a very good round. Dow surging 1,173 points. The S&P skyrocketing 4.22%. NASDAQ soaring 3.85%. Who are these two boxers? In one corner, you have a stock market that had gotten viciously oversold thanks, yes, of course, to the coronavirus outbreak and Wall Street's existential fear of a Bernie Sanders presidency. In the other corner, well, you've got the bond market, specifically U.S. Treasuries. Every time they go up in price and go down in yield, lately their yields have been plummeting, send a chill through the spine of all investors who follow both markets. Now, this is a vicious, and I will tell you, somewhat scary situation for us old hands, with bond yields so frighteningly low that they've been decking the much smaller stock market as surely as Muhammad Ali, the greatest of all time, sends so many challengers to the canvas. The bond market's still screaming that we're not out of the woods, that we're being complacent, but it couldn't land any blows today because rates actually rose. And the 10-year Treasury, which had a sub 1% yield, went back over that key level, also integral to the rally. But let me explain. First, we know there's a tremendous amount of fear in this market. We're afraid of getting sick, physically afraid. Afraid for ourselves, afraid for our families, for our children, for our parents, for our spouses. We're afraid of the economic fallout from a possible pandemic. When investors are terrified, you get what's known as a flight to safety. People just want to hide the lowest risk assets they can find, even if they get very little return, maybe no return. And U.S. Treasuries are viewed as the ultimate safe haven. And that's why wealthy investors and institutions are pouring their money into our bonds. They don't care if they make any money. They just don't want to lose it. And that's why interest rates keep plummeting. It's why the benchmark 10-year Treasury currently yields just above 1%, but was below 1% a couple of days, and that's close to record. Today's still close to record low. Buyers desperately want these bonds for protection. The sellers won't let them go, which is how you get a market that rises and rates go lower. If I were Treasury Secretary, which I'm not, I'd take advantage of this moment to offer billions or even trillions of dollars in long-term bonds. Make America great bonds. I don't care what you call them. Now, the White House can't obviously spend that money without congressional approval. But even so, this is the perfect time for the federal government to try to refinance what it can of the old national debt, or, of course, issue bonds to fix all our airports and our roads that are awful and undeveloped, whatever. Without new supply, these bonds are doomed to keep going higher every time we get scared by COVID-19, and we will again. Judging by the worldwide nature of the outbreak, I think it's a given that there'll be more bad news. I know a lot of people are feeling like we're out of the woods, but come on. I mean, it's too early. The lack of economic activity in terms of travel, leisure, dining, and entertainment pushes rates down even further. If businesses cease operating in a normal fashion and everyone starts working at home, including the people who don't have a job who ain't be working, then you're bound to get a severe economic slowdown. The bonds are signaling recession for certain because of the coronavirus. And that's why the Fed wrongheadedly slashed short rates yesterday, because lower rates won't make people more willing to go on vacation in the middle of an epidemic. Lower rates are not the tonic we need. This is more important than lower rates. This! In fact, that rate cut not only signaled panic, worse, it signaled cluelessness. They know nothing! This is not a financial crisis, for heaven's sake. It's a public health crisis. It's great to have lower rates if there's demand for money, but when there's no demand because you're too afraid to go outside, let alone go buy a car and refinance, I mean, come on. Paradoxically, what happened, the rate cuts might hurt us. I speak to many older people who seem more worried about not getting enough return from their fixed income than they are about coming down with the coronavirus. Maybe they should be more concerned because we know the death rates for older people, but I'm just telling it as it is. The combination of those fears gave us the stock market that seemed to know no bottom. But today, the other fighter, the heavyweight I bet on all my career, the technicals, gave stocks a major boost. I'm talking about the Market Edge short-range oscillator. It's a proprietary indicator that I pay to see after the market closes every day. I've been getting it for years. I've been getting it since the 1980s. It really matters to me. It used to be the S&P. Now it's put out by Market Edge. This is the source. I like to credit something that's so important in my thinking. This darn thing is so reliable that even in the midst of a bearish biological bond crisis, it allowed stocks to win the round. What does an oscillator do? It measures buying or selling pressure, and in particular tells us when the selling may have gotten out of control. When you are caught up in events, you may not actually know that things have gotten out of control. You're looking for totems, for benchmarks, for tokens, anything that makes you feel like, wait a second, the thing's gotten too crazy. And that's why I pay for MarketEdge.com's oscillator to make that judgment call for me. It's a pretty simple tool. When the oscillator is between -5 and 5, you're in the neutral zone, doesn't matter. It doesn't really work. When it goes above 5, well, there's too much euphoria. When it's below -5, there's too much gloom. Above 5, you probably want to do a little selling. Below -5, you probably want to start doing some buying, certainly cover your shorts. The more extreme the reading, the more aggressive you can get. So when the oscillator goes below -12, my benchmark, there's almost always a great time to buy, almost always. We saw this after 9/11 when that terrible tragedy turned out to be a one-off event. We saw it on August 11th of 2011 when everyone was terrified the U.S. government might default during the debt ceiling crisis, and our debt was, of course, downgraded by none other than, well, the rating agencies. S&P. We saw it in January 2016 when the Chinese stock market collapsed right at when the Fed seemed hell-bent on raising rates. And we saw it again at the end of 2018 when the Fed once again tightened way too aggressively and proved to me they know nothing. Each time was a marvelous moment to buy stocks. Each time stocks were overreacting to some news that turned out to be not as serious as Wall Street believed. Sure, things were bad, but they weren't that bad. They weren't that bad. They weren't that bad. They were bad. Who? They weren't that bad. They weren't that bad. They weren't that bad. They weren't bad. Okay. And these things were all solved. Let's talk about this, though. This is the one time where the Market Edge oscillator failed. Okay, this is what I think is the outlier, the Great Recession. If you bought stocks when the oscillator hit -12 back then, well, guess what? You did get smoked because we were dealing with the true financial crisis where nearly all of our biggest banks and big insurers, too, were in danger of going under. The government, particularly the Fed, had no idea how bad things were. By the time the Fed started cutting rates aggressively, it was too little, too late. And the stock market got more than cut in half before it bottomed, and many of our famous financial institutions became, let's just say, moribund. Now, is this coronavirus panic more like the financial crisis here, or is it like this? Which is it like? Which is it like of the -12s? The 4 times it worked in recent history, there was no credit crisis. There were no big failures. There was no systemic risk. The one time we failed to bounce, we had all those problems. The reason it was so wrong for the Fed to cut yesterday is that it made old hands like me feel like there's got to be this. This is what we reacted to, that it must be some credit crisis that we don't know about. Some institutions on the verge of the failure. Come on, Jay. Just like in the Great Recession. That's what you thought you'd do, Jay. They were trying to restore confidence. All they did was instill panic. Thank heavens we got over that quickly. As I've said over and over again, this is a biological crisis with economic fallout. It could hurt hiring, could cause layoffs. But if the federal government helps tide over small businesses and the short-term unemployed, as Congress seems to want to do, I think we'll come out on the other side just fine, even with outbreaks closing down commerce all over the country. I expect a mild recession based on weakness in travel and entertainment. But right now, the oscillator is saying you should buy stocks, both short and long term, even after today's increase. My friend Bill at Market Edge just told me we remain at double-digit negativity. More good news for the bulls. More likely that we're here and not here, okay? Of course, you could say this rally reflects more than just an oversold bounce. Obviously, Joe Biden's strong Super Tuesday performance allowed Wall Street to breathe a huge sigh of relief. Maybe we're betting on more stimulus. I don't really like that, but I heard it all day because people can't resist saying stuff like that. Maybe a possible cure. I don't think we're getting that either. But I see it say it's a traditional snapback, and even if you disagree, you can use this strength that we're getting right now. You can sell all you want. Get rid of all those bad stocks you don't like. You're worried about the Fed. Well, sell for all I care. As for me, yes, we lightened up a bit on stocks we bought during the downturn for my Jabal Trust, which you can follow by joining the ActionAlertsPlus.com club. We were just being prudent after a gigantic gain. We're still very long. The bottom line, The stock market champ put the bearish bond market challengers through the meat grinder today, turbocharged by the turn against socialism in last night's primaries. Missed the bout? Don't worry. I'm sure there'll be one again tomorrow. Wayne in New York. Wayne.
Hey, Jim.
Wayne.
Calling in tonight on SWK, Stanley Black & Decker. This past Monday, Stanley presented at the Raymond James Institutional Investors Conference, and they were given their virus impact situation. They were going over their supply chain exposure on their 10 factories in China and talking.
Yeah, well, it's good. They're moving some back. You know what? They should move all their back. I'm actually disappointed that Stanley just ceded their future to the Chinese. We see how foolish that was. Other companies are making that same darn mistake. I think Stanley would, look, if you want to do that, then go buy Home Depot. I think you want the diversity. You don't have the Chinese risk. And once again, I remind companies, watch what happened this time around. If you were too dependent on China, whether you were a drug company, whether you were a hammer company, I don't care. You look very ill-advised. And you're only getting the term ill-advised because tonight I feel like Jimmy Chill. Let's go to Carrie in Nevada. Carrie.
Hi, Jim. This is Carrie in Nevada, and I've been watching your show for a long time. I bought Boot, B-O-O-T, at 36 around 3 weeks ago when you had the interview with the CEO.
Right.
Since I bought Boot, it has gone down around 20% and has plummeted around 60% from its recent high of 48. I can't tell if it's going to continue to go down or if I should keep it.
No, I think you should keep it. I like the model. We had them on the show a number of times. Matt Boss likes them. I'll have to check in with Matt. I do think that they're in good shape. They are a retailer. Retailers have been very varied here. Greg in New Jersey. Greg.
Booyah. How we doing, Jimmy Chill?
Jimmy Chill is taking it. He's taking it. He's taking it to the house.
First-time caller, long-time listener.
Okay.
I wanted to get your thoughts on FedEx leading into earnings.
Well, you're rolling the dice, my friend. You're rolling the dice. And I don't like dice. I like cards better because I have a memory for the no-memory cards. But I think FedEx is, maybe you want to do it in calls, but you got to see. You want China to come back online. You want commerce to come back online. You want the management to come back online. That's a lot of lines. Now, in one corner, you got the stock market. In the other corner, you got the bond market. Today, the latter was put through the meat grinder. Missed it? Oh, tomorrow we'll get another bout. I think we're more like this and like this and like this and like this and not like that. Jay Powell may disagree with me. He's Fed chief. Babe, but I'm the host of Mad Money. On Mad Money tonight, with interest rates at record lows, that was just phony hubris. Could an investment in gold make sense here? I'm talking with the CEO of one of my favorites, Barrick Gold. Find out what's ahead. Then, is the most popular method of investing actually reached its apex? Don't miss my take on index funds, especially the sliver kind. And did coronavirus fears impact Dollar Tree's most recent quarter, or was it execution problems? I've got the exclusive with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.